All right. We have a couple more people joining us, but we are going to get started. So my name's Josh Heil. I'm the CEO and CIO of Citizen Mint, and we're here to talk about kind of how renewable infrastructure can bolster your clients' portfolios and bolster your own portfolio over time. And just to give you a quick background, myself, we have been a director of investments at a large wealth management firm in Seattle. We're about $16 billion in assets. I was also at Russell Investments for a number of years. So I have a lot of experience doing private market investing within this space. And also have done a lot of work within the renewable infrastructure space over the last few years specifically. So we're going to get into kind of how infrastructure can help your portfolio and help your returns over time. But first, I wanted to start with kind of what are infrastructure investments, because I think that's just like the core understanding of what they are, because there's a lot of investors out there who maybe have heard the word infrastructure, but don't totally know what it means or what it encompasses. So infrastructure investments are essential or necessary products or services. They're hard not to use even in a difficult market environment. So an example would be electricity, it would be water, cell phones, and then they usually last a very long time. So say they usually last between 20 to 50 years. And on the right-hand side of this chart, you'll see the kind of examples of how long they last. You'll see the examples of the different parts of the infrastructure marketplace. They're usually a monopoly or a quasi-monopoly within their market position. So they have limited substitutes for an asset in a geographic area. This could be like a water utility, it could be an energy utility, it could be toll roads, where essentially like there's limited substitution for that specific asset. And then they also possess a low cash flow variability. So cash flows just have limited variability across economic cycles. And you can think about this as, you're still going to use your cell phone in a recession. You're still going to use your water, your electricity across different parts of the market environment. Which is just a thing that we love about infrastructure, is that these just are not going to perform that poorly, even in a tough market environment. So let's talk about just renewable infrastructure categories, because I think it sounds, I talked about like there's some niche or myths around this, and people will say, well, that's a niche category. Well, not really. The amount of money going into these specific parts of the market is between 500 billion to over $1 trillion a year. So if you consider that niche, let's talk. But renewable infrastructure categories can include, clean power. It could be like solar, it could be wind, biogas, geothermal. And as we've seen within the US and other parts of the market, power consumption continues to increase as we electrify our economies over time. This could be through just data centers. It could be through like electrifying your home instead of using natural gas or other forms of carbon. It could be using EV vehicles. That's just an electrification process. So we've just seen an increase in the amount of electricity used, specifically here in the US, but across the world. It could include environmental infrastructure. So this could be renewable fuels, waste, and water. The US has a really antiquated wastewater and waste infrastructure that needs to be upgraded. There's also a lot of renewable fuels that we can use over time. And those can be really compelling investments. And I'll kind of discuss that a little bit more. And then it could also be within this category of renewable infrastructure, say the grid. This could be storage. It could be transmission of electricity over time. It could be efficiency. I think we all know we need to be able to transfer electricity a lot more efficiently. And our grid is talked about in the news of how susceptible it is. You see this kind of in Texas a lot, where the grid is consistently having issues when it's too hot or too cold. And they're having just like an inability to keep power on at certain points in time. So making the grid more stable over time is a huge part of this. But overall, this is just a short list of kind of the different investment opportunities. There's kind of ancillary opportunities around this that I won't mention here, but can be investable. But this will encompass probably 90% of the universe in this renewable infrastructure category. So also, I kind of talked about this a second ago, but just this myth of like, there's not much money going into this, or it's not that big of an investment category. The capital flows into the energy transition have been huge, and they're escalating pretty dramatically, actually. So you continue to see this in this chart, where this global investment in energy transition, this doesn't encompass every part of that kind of renewable infrastructure grid I just showed. But you'll see that this is a significant kind of CAGR over the last few years, where it's gone up quite dramatically. And, you know, we're seeing almost $700 billion going into it in 2022. And I think the most recent estimate as of, say, last year, if we encompass more of a broader renewable infrastructure kind of categorization, it was more like 1.2 trillion, with the estimation that actually is to hit like net zero targets by 2050. It's going to have to be over $4 trillion a year invested in these specific asset classes. And we've kind of seen the capital also start to flow into these asset classes as larger and larger investors kind of think about this and see the opportunity set there. Beyond that is also the kind of infrastructure fund growth. So this is a chart that will show you kind of how the fund growth has gone over time. So this is actually like asset managers coming out with funds, raising funds to invest in this specific part of the market. So allocations to infrastructure have gone up significantly within both institutional portfolios and are starting to trickle down in kind of into the retail landscape, where individuals are also looking at this. Institutions have been looking at infrastructure for a very long period of time, but it has been increasing part of their portfolio allocation as they kind of, there's a lot of parts of the infrastructure market that had been somewhat volatile previously. And I could say that about like midstream oil assets, where you put oil in a pipeline, and that's shown some volatility over time and some issues. But in other parts of the market, where you're investing in, say, energy or like, say, renewable infrastructure assets, you've seen kind of a little bit less volatility just because of the characteristics of those assets and the off-taker agreements. And we'll discuss that in a short moment. But you'll see here just investors are continuing to allocate to this specific part of the market in a significant manner. On the next slide, I just wanted to kind of talk about, you know, the impact of the Inflation Reduction Act and how big that has been on this specific market set. So when you look at this, this is a chart that shows all the previous kind of energy legislation or green energy legislation that's happened in the past. And you see that Inflation Reduction Act actually almost doubling what the combined amount of legislation that's happened in the past. And it was just a huge, within that Inflation Reduction Act, they did a lot of things to essentially make it easier to take the subsidies. To the most basic sense, in most cases, you can think of it as every dollar you put into solar, wind, biogas, other parts of the market, you're getting about 30 cents from the government. And then there's additional kickers on top of that of additional subsidies. If you put it in a low-income community, if you buy the components for that installation from US manufacturers. So there's a number of other things, but it also made it easier to transition kind of these subsidies, tax credits, like, and sell them on an open marketplace instead of having to have like specific vehicles where that were more complicated and burdensome to actually get the tax credit. Now, the Inflation Reduction Act is big on its own, but kind of there's also parts of it that are almost uncapped, which I want to show here. So you see that Inflation Reduction Act was $369 billion in funding. But beyond that is another 830 of estimated additional tax credits that are uncapped under the IRA. So essentially, if we're going to be building out all these things, you can actually like go much more above that. So this was an estimate by Goldman Sachs that shows kind of like the 369 million from the Inflation Reduction Act, the uncapped portion if we continue to build all these different infrastructure opportunities that we think we will build over a number of years, and then essentially the multiplier effect on that. So the multiplier is essentially not the subsidies, but essentially what you need to raise to take advantage of all those subsidies. And so you'll see that that's more closer to like $3.3 trillion in total investment. That is likely going to happen over the next decade and a little longer. And then also, I mentioned this a second ago, but just the ability of the Inflation Reduction Act, it provides more certainty to developers, which was a huge issue. You kind of saw this runoff in the amount of subsidies you would get previously when you're putting in solar or wind or battery storage. And now it's full subsidies over a longer extended period of time. So in this kind of chart on the bottom side of it, you'll see kind of the amount of solar that was put into the ground between 2012, 2021, how it increased between, it's expected to increase between 2022, or what it was supposed to be between 2022 and 2032. And then now what it's supposed to be. So it's just a massive increase in how much we expect to invest in this area because the returns have gotten that much better. So there's a lot more individuals who are interested. There's a lot more firms that are interested. BlackRock just purchased, Global Infrastructure Partners. There's a couple other large purchases within this specific part of the marketplace. And major asset managers are taking notice and raising large funds to be invested here. If we go to the next kind of how these projects work is when you're building solar or wind, how I like to explain it to a lot of investors is, you go out, build, or you start permitting, which takes a while. And then those are usually the specific developers who are permitting those assets. Then you have the big institutional investor who comes in once the permits are ready to go, once they have a power purchase agreement in place or PPA, and that's going to be just an off-taker agreement. Now, off-takers are essentially big corporates, could be local utilities who are saying, I'm going to buy the power or whatever you're producing, say if it was renewable natural gas or something else, but I'm going to buy that for the next 20 or 30 year period, and I'm going to sign a contract that says that. And usually these contracts are signed and then they increase by CPI every single year. But you can see just the amount of corporates who are moving into this space and buying these power purchase agreements over time. And these are the Amazons, Googles, Microsofts of the world who essentially have these massive data centers who have committed to getting to carbon neutral by 2030. So, we've had conversations with some top members of Amazon's energy team. And, it's like a 50-person energy team at all these big companies who are saying, I can't buy enough of this to even hit our near-term demand and our long-term demand, especially with AI coming in. That's about 4 times the amount of energy usage from a data center. So they need as much as they can possibly buy. And so you're going to see in this chart just who are the biggest off takers. And as you would expect, it's going to be Amazon, the Facebooks, the Microsofts of the world, who have a lot of these data centers and are putting them in a massive way. Especially Microsoft is going to be putting in more and more for their AI capabilities and kind of their linkage to chat GPT. And Google and obviously Meta, which is Facebook, have a lot of AI capabilities that they're implementing at the current point in time, and Amazon's not going to be left behind in that. So we expect this actually to go up pretty dramatically in how much of these PPA agreements that they'll be putting into place. So the key benefits really of renewable infrastructure over time is going to be that diversification. So it's low correlation to stocks, bonds, and other alternative asset classes. Those agreements in place essentially allow for you to say, okay, my net operating income from this asset is going to stay relatively stable over time. It doesn't matter what happens in the economy or energy prices for that matter. It's more just we have an agreement with Amazon, Google, Microsoft that they have to buy all the energy we produce from this asset for the next 20-year time frame. And so you can feel pretty confident about those specific opportunities. And that could be the case of if you're building a wastewater treatment plant and you're negotiating with the local municipality. It could be the case if you're building like solar on top of commercial and industrial properties. So there's just a lot of these cases where you're signing these long-term agreements on these long-term assets where you're just not going to see the volatility that you might see in other parts of the market based on how the economy is doing. They're also going to produce income, and that's just based on the net operating income that I just mentioned, just highly predictable cash flows. And usually that provides strong income to the ultimate investor in their portfolio. And we'll talk about kind of those dynamics in a second around taxes of that income, because it's also pretty favorable. To the point about defensiveness, these are steady cash flows. In a lot of cases, there's some decent barriers to entry. It does provide some inflation protection. So the pricing of these assets when they're coming to market is going to go up with the pricing of inflation, or it's regulated into the specific contract where if inflation goes up, then the pricing that the off-taker pays is going to go up as well. There's a lot of government support here as a result of the Inflation Reduction Act. And these are long-term assets. So these are real assets that are in the ground that have value over a long period of time. I should mention on the government support, because this is a question that comes up a lot, is like, what happens if there's an administration change, and how could that possibly affect these asset pricings? And it's literally probably one of the top questions we get. And what I tell individuals when discussing that is, one, it's relatively difficult, especially to turn over this large legislation. And two, a lot of states, a lot of red states actually benefit from this specific act. Most people wouldn't know, but like Texas is one of the largest renewable energy states in the US. So they have a lot of jobs within this space. They have a lot of capital infrastructure within the space. Florida also has a lot of renewable energy, as well as a number of Southwest or Southeast states. So we just don't see them killing jobs. We don't see them killing capital investment into their states, which would be just hurt them from a political standpoint if they were to do that. So we just don't see that as a huge risk to this the government support of this asset class. And then growth. When people talk about this, it's like, this is the largest capital investment cycle we'll probably see in our lifetimes. It's a massive energy transition, and we think there's just a lot of opportunities within this space. Some that we might not have even explored in the current, because the technology is not there, like green hydrogen in the future could be something that's really interesting, not there from a cost perspective right now to be highly investable. So now I want to move on to just like utilizing this in portfolios and how it can possibly impact your portfolio. So one of the things that we love about this is the reduced volatility of the asset over time. I think when clients think about privates, they start thinking about private equity, and they're like, how can private equity, or that would be the first place we should allocate to in private markets. And it's like, when you look at the actual numbers of how volatile private equity can be over time, or venture, or even real estate, then you look at private infrastructure and you realize it's about half the volatility of those other asset classes. And it makes sense. Like, actually, private equity is probably a little bit higher than that if it was realized volatility. But these are from Cambridge numbers on these specific asset classes. But you also see it has half the volatility of the S&P 500. So you're getting really low volatility asset class, but also the potential for decent higher returns than those asset classes. So as I said, the demand for renewable infrastructure is significant. The subsidies are significant. And there's just a lot of opportunity to invest in this space at the current point in time. And so when we look at the return expectations, we're looking at 9 to 11% on the low end, and then say 14 to 18% on the higher end net returns. And core infrastructure, when I say core renewable infrastructure, that would be in the ground like assets. So solar, wind assets that have already been built, that you're not taking any development risk on, and you're just mostly taking the income off those specific asset classes. Development, you're obviously getting a higher return because you're taking some construction risk on those assets. But usually in that case, you already have still a contract in place before you even start developing. So you usually you've already sold your future energy to Amazon even before you've even started construction on that specific asset, which does take away some of the risk there. So you don't have to worry about that in the future. And then debt for renewable infrastructure has been a big topic. So regional banks don't usually lend to these assets and have pulled back lending to other parts of the market. And they might have been a portion of lending in the past. And then as interest rates have gone up, we're seeing about 12 to 14% kind of loan rates within this specific part of the market, which is obviously very compelling from a returns perspective. Some other portfolio impacts is tax efficiency. So most of the returns are actually very highly tax efficient, given the nature of the asset class. So essentially what you do is, when you're getting income, which can be a significant portion of returns, say 4 to 8% of those returns can be income. That's actually considered a return of principal. And how they do that is they take special depreciation on the specific assets over the first 10-year life of the asset. And then it's considered a return of principal, and then you pay a long-term capital gain at the very end when the asset is sold. So from a tax perspective, great for clients comparatively. And then I also want to talk about kind of just sizing in portfolios. And I kind of mentioned this previously, that a lot of individuals will think of like private equity, private debt, other opportunities as kind of their first go-to within a portfolio context. And it's like, given the risk return dynamics of this specific asset class, it can be kind of a core allocation and actually can be decently sized within a client portfolio without you having to worry about it being a huge risk on the client's ultimate returns or specific goals. So, and it really depends on the client based on their risk appetite, based on their liquidity needs and liquidity preferences. For most of these opportunities, they can last in duration between 5 to 10 years to even like 14, 15 years. We've been looking at more ones that are between the 5 to 10 year period as the opportunities that we've been most interested in. And I just wanted to mention these again. And I think I did mention them as we were kind of going along, but like niche asset class, it's the largest capital investment cycle ever, $500 billion to $1 trillion in yearly investments. And then also the one I get, it's only for clients interested in the environment. It's like, hey, we just don't have many clients interested in ESG or impact or the environment. It's like, well, do they want to invest in the largest capital investment cycle ever and get returns and have lower volatility in their portfolio? Then I think most clients would be interested in that. And it's also just one of the best investment places we've seen in the private marketplace over the last few years. And it has better metrics than private equity and less economically dependent. So that's most of my prepared kind of discussion comments. There is a Q&A box where you can add in questions that you might have about this specific topic. And I have some appendix slides that we can go into, but that was most of it, just to kind of hit on why it's interesting, why we think it's a really compelling place to be looking for your clients or yourself, and where we're seeing kind of the opportunity set. And like I said, there's a lot of things happening within the space at the current point in time. There's a lot of investment happening, and we think it's just one of the best places to invest right now. So I will open it up to questions. Like the Q&A should be pretty easy to find, or you can go into the chat. I guess Q&A is the easiest place. And I will just wait for those questions to come in. And then I just want to make sure I didn't miss anything. Couple, I think I should mention, I think I already mentioned the administration risk. And then I assume this is a question that most people would have, is like, what are the other major risks? So one of the risks I usually like to mention is just if there was a large import ban on solar panels from China, that could be a risk within the specific asset class. And usually that's mitigated by both the investment. Well, hopefully nothing happens with China over the next 3-year period. But as we kind of like go into this investment period, but also the build out of U.S. solar manufacturing facilities. They're not cost competitive with China at the current point in time. With subsidies, they get closer, but still not there. But there is a number of large solar plants getting put online over the next few years, which should help, and probably also some being made in Mexico as well. So just a couple of questions. Can you describe the specific opportunities available right now? Yeah, and I think I think for us as a firm, we've been looking at, debt opportunities within this space. We've been looking at commercial and industrial opportunities within this space, large core opportunities. So those are just like in the ground solar, wind, 9 to 11% kind of expectations on return. That's actually increased about 2% comparatively before the Inflation Reduction Act. Sizing and minimum investment can be based on the specific opportunity that you're utilizing within the market. So some of these are a lot of big institutional managers. So some of them have, minimum investments of say $5-10 million, but from a citizen perspective, we try and decrease that. Couple other questions. What kind of insurance is in place for natural disasters? This would be pretty common insurance, like hailstorms for solar, wind. There's also usually like hurricane insurance and other kind of insurance for those specific, depending on what they are specifically doing. Pretty common within the industry to have insurance in place for most big natural disasters. Local, regional, or national exposures. So in a lot of cases, these are national exposures. They can benefit from local and regional opportunities, say battery storage in New York City. There's a lot of incentives in New York right now for batteries. So in putting batteries in place, so you can benefit from both the national IRA subsidies as well as the independent state subsidies. And that's what a lot of developers are doing, is kind of like taking those into account when they're reviewing these opportunities at across different locales and regions. Any other questions I can answer here? Otherwise, I don't really want to take much more of your time. You can send me an email after the fact if there's a question that didn't get answered, but you want it to be answered. I'll probably try and also get the slides out as well as a recording out after this. So if you want to send it to anybody within your network, or if you just want the slides or some of the graphs, if those are helpful. And then, yeah, look forward to connecting with any of you on a future basis. And thanks for joining.